$100K in portfolio gains could cost you $18K, $22K in taxes this year, unless you move before December 31. Here's the mistake dividend investors make during every market rally. They assume their tax bill can wait. It can't. If you're holding a $500K dividend portfolio and the market just handed you a 20% rally, you're sitting on roughly $100K in unrealized gains. That feels amazing, until you realize that cashing in even half of that windfall in a single calendar year could trigger the net investment income tax, a 3.8% surtax on top of long-term capital gains. For a household earning $300K or more, that's $18K, $22K in combined federal tax on those gains. Spread the same $100K across 2 tax years. Your total tax bill drops to $12K, $15K. That's a $3K, $10K difference, purely from timing. By the end of this video, you'll know exactly which positions to sell and when to sell them. Let's start with the reality most dividend investors don't face until April. The IRS Form 8960. Form 8960 is where the 3.8% net investment income tax, NIIT, gets calculated. For married filers, the surtax kicks in once your modified adjusted gross income exceeds $250K. Your dividend income, capital gains, and even rental income all count toward that threshold. If you earn $300K a year and your portfolio throws off $40K in dividends, you're already $90K over the line. Add a $100K capital gain realized this same year, and you've just triggered NIIT on a portion of that gain. The IRS didn't announce this loudly. You won't see a separate bill. It just appears on Form 8960 when you file. Here's the concrete impact. Imagine you're married, earning $280K in W-2 income, with a $500K dividend portfolio yielding 3.5% per year. That's roughly $17,500 in annual dividend income, all counted toward your Magi. Your portfolio rallies 20%, a $100K gain. You decide to sell $50K of winners this December to rebalance. Your Magi jumps to $330K. The portion of your realized gains above the $250K threshold triggers NIIT. On a $100K gain, roughly $80K of it sits in the NIIT zone. That's an extra $3.040 in surtax, on top of the 15% long-term capital gains tax itself. That's $15.040 in federal tax on the $100K gain, not counting state or alternative minimum tax. Now here's where it gets worse, and where most pre-retirees miss their biggest opportunity. Tax policy uncertainty is real. If capital gains tax rates rise in 2025 or 2026, as some proposals suggest moving from 15% to 20% or higher, locking in gains at today's 15% rate could save you 5-10 percentage points on future realizations. That's $5K, $10K of permanent tax savings on a $100K gain. The window to execute this is narrow. You have until December 31 to realize gains at 2024 rates. After that, you're gambling on what Congress does. Spreadsheet model is straightforward. First, list your winning positions by cost basis and current value. Calculate your 2024 Magi from all sources, W-2, dividends, other income. Identify how much capital gains you can realize before hitting the $250K Magi threshold. That's your tax-efficient zone. Sell positions in that zone first. You owe 15% long-term capital gains tax, but 0 NIIT. Then, if you want to harvest additional positions, you can. But now you're paying the extra 3.8% surtax. The model tells you exactly where the math breaks even and when to stop selling. For a typical pre-retiree with $500K, $1M in dividend stocks, this exercise often reveals $20K, $50K in annual tax savings just by shifting which year you realize which gains. That's not theoretical. That's IRS Publication 550 and Form 8960 in action. One final pattern. Don't wait until January. The Tax Cuts and Jobs Act expires in December 2025. Current capital gains brackets are scheduled to revert to 2012 rates, up to 20% on gains plus 3.8% NIIT, plus possible state tax. If Congress doesn't act, every gain you realize in 2026 and beyond could owe 5-10 percentage points more. Locking in gains at today's rates before year-end is one of the few remaining high-income tax levers. The math is overwhelming. A household with $300K income and $100K in gains could save $5K, $8K just by deciding to sell this month instead of next year. If you want the full spreadsheet model and implementation checklist for your exact income bracket, the deep version with every IRS citation and case study is in my book Market Cycles Decoded *. Link in the description. Here's your takeaway. A market rally creates a narrow, urgent window for tax loss harvesting and strategic realization. Ignoring cost basis management during rallies can lock you into a 15-20% lifetime tax drag on gains you could have harvested tax efficiently across multiple years. The decision isn't whether to sell. It's which positions to sell and when. That decision is worth $3K, $10K per household right now. If this changed how you're thinking about your dividend portfolio, hit subscribe. I'm covering the one tariff most dividend investors are missing in the next video, dropping Friday. Ring the bell so you don't miss it. What's your biggest takeaway from this year's market rally? And is your portfolio heavy in dividend stocks? Let me know in the comments. Markets reward the patient and the prepared.